Hey everyone, Verizon offers investors a dividend yield of 6.71%. Target offers passive income investors a dividend yield of 3.1%, but only one can be the better dividend stock for passive income investors. So let's look at these two companies, let's compare them on their financial metrics and determine which one is the better buy for passive income investors in 2024 and beyond. Let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
As I mentioned in the beginning, their dividend yields are widely apart, with Verizon offering more than twice the dividend yield of Target. But when I'm thinking about investing in a dividend stock, I'm not just looking at the dividend yield. I understand that I'm exposed to the fluctuating stock price, which could eliminate or augment my dividend yield. And so I look at more financial metrics than the dividend yield. So let's look at some of the other metrics that I consider when I'm evaluating dividend stocks. One of the things I consider is the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable, because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example, where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. So that being said, we can see that Target has had an earnings per share above its dividend per share for the better part of the last decade, save for this brief moment in 2015. Verizon, meanwhile, has had a earnings per share that's been above its dividend per share for the better part of the last decade. And each of these two dividend stocks has been comfortably above its dividend per share in terms of earnings per share in the last decade. So neither of these two companies seems to be at risk of having to pause or decrease their dividend per share. Another thing I consider is the company's revenue growth over the last decade. And in this metric, Target has been superior. You can see Target's revenue expanding from 70 billion all the way up to 107 billion in the most recent trailing 12 months, while Verizon has grown from about 122 billion up to 134 billion. For the next decade, I expect Target to grow revenue significantly faster than Verizon at more than twice the rate of Verizon. I expect Verizon to grow revenue in the low single digits, whereas I expect Target to grow revenue in the mid single digits. So I'm thinking something like 1 to 3% for Verizon, and for Target, I'm thinking something from 4 to 5% revenue growth. So nearly double the revenue growth rate from Target going forward in the next decade compared to Verizon, because Verizon's market is saturated. Not very many new customers signing wireless payment plans. That market is saturated. It's only dependent on market share gains and increases in average revenue per user, whereas Target can expand its market. Its recent investments in same-day delivery services has been impressive, and Target's best-in-class same-day delivery service has attracted newer customers, has attracted returning customers. You can see, of course, you remember Target was one of the prime beneficiaries of the pandemic. That's where you saw its revenue explode higher. But given its excellent service, given the way it was able to meet that higher customer demand, folks have stuck around. Its revenue hasn't dropped back down to where it was pre-pandemic. It's came down a little bit, but not back down where it was before the pandemic. And so that is a testament to Target's excellent service, the way it invested in the stores to make it attractive for people to visit brick and mortar stores again, and to use their stores as a competitive advantage now with those same day services, the buy online, pick up in store, buy online, pick up in the parking lot. Those have proven to be incredibly popular. All right, the next thing I look at is the operating profit margin of each business. And in this metric, Verizon has the big lead with a 22% operating profit margin compared to 4.68% for Target. Verizon should be able to sustain a roughly 20% operating profit margin, where Target, I think 6% is their longer term sustainable operating profit margin. This 8.5% it achieved, that was due to the boom during the pandemic. Over 8% not sustainable for Target, but also this 4% is not sustainable. I'm sorry, not that it's not sustainable. What I mean to say is this 4% is due to the impacts of the economic reopening and the pullback from the boom in sales. So the more stable equilibrium level for Target is roughly 6% operating profit margin. The next thing I consider is the cash flow from operations to sales. And in this regard, again, Verizon with the lead at 28% compared to 8.23% for Target. And I suspect this to be in Verizon's favor going forward. The interesting thing here is long-term debt. I like to look at long-term debt to determine a unique risk outlier, and that's precisely what we see here with Target and Verizon. Verizon with $147 billion in long-term debt compared to just $16 billion for Target. This is a considerable risk, and it highlights Verizon's business model and the unique risk of Verizon's business model, in that every few years or so, or every decade or so, it needs to invest significant capital to upgrade its technology. This latest upgrade was in the 5G technology. Prior to that was the 4G, and prior to that was the 3G, right? But every so often it needs to upgrade that technology, and that's billions of dollars in investment. That's why you can see Verizon's business, when you look at it in terms of operating profit margin and cash flow, it looks attractive, but you have to consider that Verizon spends billions and billions of dollars so that it can have that attractive business model, right? Target doesn't need to do that. It doesn't need to spend billions of dollars every few years adding new store locations. It needs to spend some money to upgrade those locations, like it did in upgrading the same-day services, but not as much as Verizon, and so it's not as risky as Verizon. Finally, I wanted to look at valuation, and judging by the forward price to sales ratio, Target is nearly twice as expensive as Verizon, with a forward PE of 15 compared to Verizon with the forward PE of 8.396. Still, despite this more expensive valuation, as a passive income investor, I would prefer Target going forward because of the lower risk profile and the better revenue growth expectations going forward. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.